Welcome to 1 Minute Finance, your quick shot of business wisdom. First up is GDP, or Gross Domestic Product. GDP measures the total market value of all finished goods and services produced within a country's borders in a specific time period, typically quarterly or annually. It includes everything from government spending and business investments to consumer purchases and exports, minus imports. A rising GDP indicates economic expansion and business confidence, often leading to higher corporate profits and stock market growth. On the other hand, a declining GDP may signal reduced production, job losses, and a contracting economy. Economists often distinguish between nominal GDP, which includes inflation, and real GDP, which adjusts for it, giving a more accurate picture of growth over time. Next is CPI, the Consumer Price Index. CPI measures the average change in prices over time for a fixed basket of goods and services. This basket typically includes essentials like food, rent, clothing, healthcare, and transportation. A moderate rise in CPI is normal in a growing economy, but sharp increases can indicate rising inflation, which erodes purchasing power. Investors pay close attention because inflation affects interest rates, bond yields, and even stock prices. High inflation may lead central banks to raise interest rates, making borrowing more expensive and potentially slowing economic growth. Unemployment rate. The unemployment rate is a key measure of labor market health. It reflects the percentage of people in the labor force who are actively seeking but unable to find work. High unemployment can reduce consumer spending, slow economic growth, and signal underlying issues in the economy. Low unemployment typically indicates strong job growth and rising wages. But if it's too low, it can lead to labor shortages and wage inflation. Economists also look at underemployment and the labor force participation rate for a fuller picture of employment conditions. Interest rates. Interest rates, especially the benchmark or policy rates set by central banks, are crucial levers for managing economic activity. Lower interest rates reduce borrowing costs, encourage spending and investment, and can stimulate a sluggish economy. Higher rates can help cool down an overheating economy or fight inflation by making credit more expensive. For investors, interest rates affect everything from bond prices and mortgage rates to stock valuations and currency strength. Trade balance. The trade balance shows the difference between a country's exports and imports. A trade surplus means a country exports more than it imports, which can strengthen its currency and boost GDP. A trade deficit, on the other hand, can weaken a currency and raise concerns about long-term economic sustainability.